Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is February 6, 2025. Good morning, everyone. I hope you're ready for an in-depth discussion on what's happening in the markets. Today, we have a lot to unpack, from the latest market data and intriguing news stories to more detailed analyses on the sectors driving the story. So sit back, grab your morning beverage, and let's dive right in.
Let's begin with a quick market overview. The S&P 500 is trading at around 6,074.3, showing an almost imperceptible positive change of roughly 0.03%. In contrast, the Nasdaq is a little quieter, with a minor dip of around 0.14% from its previous levels, closing at nearly 19,698. It appears that investors are taking a cautious stance in our tech-heavy index today. Meanwhile, the Russell 2000 is inching upward, enjoying a gain of approximately 0.8%, sitting at about 2,316 points.
Turning our attention to the cryptocurrency markets, Bitcoin is showing a notable resilience, with its price hovering near 98,725, posting a healthy increase of about 2.26%. Over on the Ethereum front, the situation appears a bit more mixed. Ethereum has seen a slight decline of around 0.46%, settling at roughly 2,775. It's interesting as we witness this divergence in digital assets, with Bitcoin seemingly riding the momentum and Ethereum taking a little backseat today. It reminds me of that old joke among crypto enthusiasts: Bitcoin might be the king of the castle, but Ethereum is busy building the moat and the drawbridge.
Now, moving deeper into the forces shaping today's markets, let's talk about some broader trends. We're living in a world where geopolitical tensions, technological innovations, and shifting consumer expectations are all colliding at once. One significant trend gaining traction is the interplay between innovation and technology and the supply chain disruptions that have been prevalent for quite some time now. The technology sector is showing a peculiar mix of resilience and hesitation. We see tech indices like the Nasdaq slightly declining today, perhaps a reflection of profit-taking or a cautious recalibration after some recent exuberance.
On the other hand, the traditional financial and consumer sectors are dancing to their own tune. The modest rise in the Russell 2000 might be interpreted as smaller companies stepping up and gaining investor confidence as they show agility in the midst of these turbulent times. Moreover, when we zoom out and factor in global events such as central bank policies and fluctuations in energy prices, it becomes clear that these macro forces are interwoven into our daily trading narratives. For instance, we have commentary from the Bank of England, which recently took the unexpected step of cutting interest rates by a quarter point. That decision, part of its third rate cut since August, signals policymakers' intention to stimulate economic growth even in the face of a slowing recovery.
Then there's the energy sector. Oil prices have been on a fascinating journey recently. Just yesterday, crude prices were pushed higher after Saudi Arabia's state-owned petroleum company ramped up physical crude prices for the Asian market. The reaction in oil futures has been modest, but tells a story of a sector that is very sensitive to supply dynamics and geopolitical maneuvers. There's an undercurrent here that suggests energy markets are adapting to a new normal where geopolitical actions can shift sentiment almost overnight.
And let's not forget the individual companies stirring the pot with some rather colorful headlines. One of the headline stories that has caught everyone's eyes lately is centered around Skyworks. The reports are unequivocal. Skyworks stock has taken a severe hit, described by analysts as a nightmare realized. In what could be its worst day in more than 4 decades, the stock seems to be in freefall. The catalyst here appears to be Broadcom's strategic move targeting a lucrative socket opportunity for Apple's iPhones. Essentially, during investors were scanning for stability in a rapidly changing technological landscape, Skyworks was caught off guard by competitive maneuvers. It's a stark reminder that no company, regardless of its past pedigree, can rest on its laurels in such a competitive environment. For those of you who like a good underdog story with a twist, this is an example of how even a giant can stumble when innovation and strategic plays come crashing in.
Another set of stories that's been making waves involves Peloton. In a twist of fortunes, Peloton appears to be on an upward trajectory once again. The company reported strong revenue figures, largely driven by robust demand for its tread products. Investors celebrated this as the widest revenue beat seen since 2019. The positive sentiment around Peloton is partly due to the resurgence in at-home fitness trends, which have become so ingrained in our lifestyles. It seems like the fitness giant is not just spinning its wheels, but is actually accelerating, a move that has certainly caught the attention of market watchers. If nothing else, Peloton's success could prompt competitors to revamp their strategies in order to capture a slice of this rapidly growing market.
Switching gears to international influences, the recent move by the Bank of England has not gone unnoticed by investors globally. The decision to cut interest rates by a quarter point has been interpreted by some as a preemptive measure to bolster economic activity in the face of uncertainty. Historically, when central banks adjust rates, it sends ripple effects across global markets, influencing everything from currency valuations to investment flows. In this case, while the move is designed to stimulate growth, it also highlights the balancing act that regulators must perform. Lower rates may encourage borrowing and spending, but they also carry the risk of fueling asset bubbles if not managed carefully. Investors are now weighing these risks as they consider portfolio adjustments in response to policy shifts not just here, but around the globe.
Energy as a sector remains a linchpin in our overall market analysis today. As oil prices attempt to bounce off their lows from 2025, market participants are keenly watching developments in Saudi Arabia. The significant increase in crude prices set for the Asian market is not just a number, it is a signal. A signal that supply constraints and geopolitical considerations still weigh heavily on one of the world's most critical commodities. For those of you tracking the energy sector closely, this is an important development that could have long-term implications for inflation, transportation costs, and even the global economic outlook.
Now let's expand our coverage to a comprehensive set of headlines that are weaving the narrative of today's market dynamics. We're seeing strong thematic connections between technology, consumer behavior, central bank policies, and energy sector developments. Starting with the repeated reports on Skyworks, it's clear that competitive pressures in the tech sector are intensifying. Investors who had previously pinned hopes on consistent performance from companies like Skyworks are now scrambling for alternatives as market shares shift rapidly in response to aggressive moves by competitors such as Broadcom. This kind of shakeup makes one wonder whether we are witnessing just a temporary blip or the beginning of a longer-term trend where market leaders are replaced by more agile, responsive companies. It might even be a rallying cry for other firms to step up their innovation game.
Then there's the remarkable story of Peloton, where the sector is not only rebounding but is signaling rebirth through its impressive revenue jump. The narrative here is one of resurgence and adaptation. While many companies have been grappling with post-pandemic adjustments, Peloton seems to have found a way to capitalize on its niche. The strong demand for tread products in particular underscores a broader trend where consumers are increasingly embracing at-home health and fitness solutions. Perhaps it is no coincidence that as the trends in digital transformation and personal well-being converge, companies like Peloton find themselves well-positioned to profit. But then again, in the unpredictable world of markets, today's winning formula could be tomorrow's cautionary tale if the momentum shifts unexpectedly.
Moving on to the decision from the Bank of England, a rate cut, even if just by a quarter point, sends a distinct message. It is a declaration that the economic challenges we face are real and that policymakers are prepared to take bold steps to mitigate them. While the move is aimed at stimulating economic activity, the caveat of potential asset bubbles cannot be ignored. It is a delicate balance, much like riding a bicycle on a tightrope while juggling apples, impressive if done right, but disastrous if one loses focus. This decision also prompts us to consider the global implications, particularly as investors around the world monitor changes in policy signals. Central banks in other major economies might view this as either a competitive move or as an opportunity to adjust their own monetary strategies.
For the uninitiated, remember that central bank policies are akin to the steering wheel of the global economy. They might not control the entire ride, but they certainly influence the direction and speed.
On the energy front, oil prices are trying to find their footing after reaching lows earlier this year. The news that crude prices have received a boost after Saudi Arabia's decision to hike prices for the Asian market is a vivid reminder of how interdependent global commodity markets are. Energy is the lifeblood of the global economy, and small adjustments in pricing can have ripple effects across industries from manufacturing to consumer goods. For traders, this is an area that requires close monitoring, as the interplay between geopolitical decisions and supply-demand dynamics can create sudden and dramatic shifts. And, speaking from personal experience, if you like a bit of excitement with your morning cup of joe, watching energy prices can be as thrilling as riding a roller coaster just with higher stakes than your average amusement park ride.
Let's now dive into a detailed sector analysis. Considering the latest news, the tech sector clearly continues to be a hotbed of activity. The competitive battle between Skyworks and Broadcom is a classic example of how fortunes can change overnight in technology-driven industries. One minute your portfolio looks bright with a familiar name, and the next day you're wondering if you missed the memo on some strategic acquisition or partnership changes. Technology companies are now more than ever measuring their value not just by their current earnings, but by their ability to innovate faster than their peers. In this climate, even a minor product misstep or a strategic oversight can cascade into significant market repercussions.
The energy sector, as we discussed, finds itself amid a period of cautious optimism. With oil prices slowly rebounding and central banks making moves that could influence inflation expectations, energy companies are under the microscope. Investors need to be mindful that while demand may slowly recover with economic stabilization and enhanced consumer confidence, geopolitical uncertainties remain a wild card. The tension between supply constraints and demand growth could lead to a period of volatility, one where prices and company valuations oscillate more dramatically than we have seen in the recent past. It's a sector where long-term structural trends, such as the shift to renewable energy sources, intersect with short-term geopolitical maneuvering, a fascinating duality that both excites and cautions investors.
When we shift our discussion to the financial sector, the results from the Bank of England's rate cut underscore the tenuous nature of modern banking and finance. The simultaneous need to stimulate growth while keeping inflation in check puts bankers and regulators in a challenging position. Financial institutions are now tasked with navigating a maze of uncertainties. Each interest rate adjustment is a gamble on the future behavior of markets. For investors, this means that banks and other financial institutions will remain under intense scrutiny. Performance metrics and capital adequacy ratios will be more important than ever. The dance between risk and reward in finance has always been delicate, but today's economic environment makes it even more intriguing, almost like solving a complex puzzle where every piece counts.
Global market implications are also worth noting. In today's interconnected world, a decision made in London or a price hike in Riyadh resonates far beyond its immediate borders. The actions of one country's central bank or a strategic price adjustment by a major oil producer can prompt shifts in investor sentiment globally. This environment requires investors to adopt a more holistic perspective, looking beyond domestic markets to understand international developments. Does a rate cut in London signal that Europe is gearing up for a prolonged period of caution? Or does the increase in crude prices foreshadow further tightening in supply, which might eventually lead to inflationary pressures worldwide? These are the questions that keep market analysts up at night, and I suspect they might be keeping some of you awake as well. If not, perhaps the volatility of the markets is giving you sleepless nights instead of counting sheep.
Before we wind down our discussion, I'd like to share some expert insights and predictions. The market appears to be at a crossroads. On one hand, you have clear signals of renewed energy in sectors like consumer electronics or at-home fitness, as evidenced by the stories out of Peloton and Skyworks. On the other hand, there's an underlying caution that is palpable in many corners of the market, from the subdued performance of the Nasdaq to modest rate cuts by major central banks. In my professional opinion, we are in a phase where momentum is building slowly, and when it picks up, it could bring rapid changes across multiple sectors. Investors would do well to stay nimble and consider a diversified approach to capture growth while hedging against uncertainties.
One thought-provoking question I often ask myself, and which I encourage you all to mull over throughout the day, is whether these isolated moves represent a broader structural shift or are simply temporary adjustments in an otherwise steady economic cycle. It is questions like these that remind us that markets are living, breathing organisms, ever evolving and unpredictable. And if you ever find yourself wondering whether you should be buying, selling, or holding, just remember that every market downturn is a reminder to look for opportunities and that every rally holds lessons for the future.
As we wrap up today's discussion, let's take a moment to highlight some key takeaways. The overall market sentiment remains cautious yet optimistic. While the S&P 500 and Russell 2000 offer signs of steadiness and even mild growth, the Nasdaq is signaling lingering concerns in the tech sector. Cryptocurrencies are showing divergent paths, with Bitcoin on an impressive upward trajectory and Ethereum experiencing a slight dip. Major news themes from Skyworks' troubled day amid competitive pressures to Peloton's inspiring revenue surge and the impactful decision by the Bank of England to cut interest rates paint a picture of markets that are as dynamic as they are unpredictable. Add to that the energy sector's interplay between crude price adjustments and global supply uncertainties, and it is clear that rich opportunities and equally significant risks remain abundant.
I'd like to give a special shout out to Pantheon AI, your information co-pilot, for helping us navigate these complex market dynamics. They have been instrumental in providing real-time data and insights that allow us to discuss these topics with the nuance and depth they deserve. Remember, learning shouldn't feel like a full-time job, and with the right tools and partners by your side, you can always stay ahead of the curve.
Before we close for today, let's leave you with a few questions to ponder. Are these market fluctuations an early sign of recovery in tech sectors once the competition settles, or could they be indicative of deeper structural shifts? Might the rate cuts by the Bank of England be a catalyst not just for economic growth, but also for riskier asset profiles worldwide? And finally, as energy markets react to geopolitical shifts and pricing decisions, what strategies should investors adopt to protect their portfolios without missing out on potential upside? I invite you all to think about these questions as you review your portfolios and consider your next steps in this ever-changing landscape.
That's all for our morning briefing today. I want to thank you for joining me on this journey through the intricacies of the markets this fine February morning. Remember to tune in again tomorrow as we continue to monitor these stories, analyze new trends, and provide you with the detailed insights that empower you to make informed decisions. And as always, if you have questions or want to explore a topic in more depth, feel free to reach out to our AI co-pilot for more tailored analysis.
Thank you for listening, and I look forward to our next conversation. Until then, keep questioning, stay informed, and remember that learning shouldn't feel like a full-time job. Have a great day, everyone.